Welcome to this explainer. Today, we're unpacking a really wild situation in the market right now, the Datadog earnings paradox. We're going to dive deep into one of the most consequential and frankly fascinating earnings reports of the year from the cloud monitoring giant and figure out the intense tug-of-war currently gripping the market.
Imagine this for a second. A tech giant absolutely crushes every single expectation on paper, right? And then, boom, it loses 17% of its value in a single morning. How on earth does that happen? It sounds completely counterintuitive. So today, we're going to solve this mystery and figure out exactly what it means for anyone watching the tech sector.
Let's jump right into part one, the earnings paradox, strong numbers, steep drop. Looking at the undeniable facts of the Q2 report, the headline numbers were, honestly, off the charts. Right out of the gate, Datadog posted a massive $1.12 billion in revenue. That is a 36% jump year over year, completely blowing past consensus estimates. They are growing at a phenomenal clip.
And it wasn't just the top line. They also beat on profitability with an adjusted earnings per share of 65 cents. Plus, they generated $316 million in operating cash flow, meaning actual cash is pouring into the business, all while just casually sitting on a $5 billion cash fortress. Fundamentally, this balance sheet is incredibly strong.
But here is the paradox. Despite knocking it out of the park across the board, the stock nosedived almost 17% in early trading. You almost never see double-digit drops on a quarter where a company beats and raises expectations, right? So what gives? Why did the market react with such hostility to fantastic news? Well, it basically boils down to this. The stock was priced for absolute perfection. Think about it. Heading into earnings, Datadog had already rallied over 100% year-to-date. The bar wasn't just high, it was in the stratosphere. So when their Q3 and full year 2026 guidance came in solid, it was good, but it wasn't spectacular enough to justify that massive run-up. So, investors aggressively took their profits and ran.
Moving on to part two, the bull case, the unstoppable growth machine.
So why are the bulls completely unbothered by this drop? Well, Datadog CEO Olivier Palmel summed it up perfectly. He called it a race against complexity. What he means is that as AI makes cloud systems more and more chaotic and difficult to monitor, Datadog's unified platform basically becomes the central nervous system that IT teams literally can't live without.
And their land and expand strategy? It's working like a charm. 56% of their customers are now heavily integrated, using 4 or more products. That means once Datadog gets its foot in the door, they stick around and embed themselves deeper and deeper into a company's operations, making them incredibly sticky.
Plus, they're going all in on AI. Their Bits AI agent suite has already handled over 100,000 investigations. They just scooped up Adaptive ML, and get this, 14 of the top 20 AI-native companies are already Datadog customers. Add in the 100 new capabilities they just launched at their Dash 2026 conference, and they are clearly riding that cloud megatrend all the way to the bank.
But hey, there's always two sides to a coin, right? Let's flip it over for part three, the bear case, the valuation reality check.
The biggest red flag for the bears? A massive, staggering price-to-earnings ratio of 745. Think about that for a second. Investors are paying $745 for every single dollar of profit this company actually makes. That is an insanely expensive premium, and bears argue the stock is priced for a reality that Datadog isn't currently reporting.
Because when you're paying a premium that high, any sign of slowing down is terrifying. Right now, growth is cruising at a very healthy 36%, but the projected guidance implies a deceleration down to 26% by fiscal year 2026. When a stock is priced for perfection, dropping down to 26% is like slamming on the brakes. It triggers panic, leaving absolutely zero margin for error.
It's not just the math either. Datadog is fighting tooth and nail against some absolute heavyweights for consolidated enterprise budgets. We're talking Cisco, Dynatrace, Microsoft, and IBM. The consolidation trend is great, but it means everyone is throwing punches for the exact same enterprise dollars.
Then there's the OpenAI wildcard, which is definitely adding fuel to the fire. Right now, OpenAI is a massive Datadog customer, but word on the street is they're building their own in-house platform. If OpenAI actually bails, Datadog loses a huge chunk of revenue, sure, but it also takes a brutal reputational hit that might make other enterprises wonder if they even need a third-party platform at all.
And you can't ignore the insider selling. Over the last 90 days, insiders, including the CEO and CTO, have dumped about 1.4 million shares, totaling $337 million.
Now, to be completely fair, a lot of these sales were done under prearranged automated trading plans. But still, when growth is supposedly slowing down, seeing leadership cash out is a warning sign that definitely makes investors sweat.
So where does Wall Street stand? Section 4. The Analyst Split. Bulls versus Bears.
It's a total tug-of-war right now. The bulls are doubling down, top firms are aggressively hiking their price targets way past $300. You've got RT Research, Cantor Fitzgerald, Citigroup. They all see Datadog as the undisputed winner as companies look to consolidate their fragmented tools.
But that optimism is crashing right into a brick wall of bearish reality. You've got RBC Capital saying the sell-off is totally overblown, while quantitative models from places like Simply Wall Street are saying, hold on, fair value actually implies an 8% downside from here. The debate is simple. Is this 36% growth the exception or the new normal?
Which brings us to Section 5, Key Catalysts to Watch.
If you're analyzing Datadog right now, circle these fall 2026 tech conferences on your calendar. Starting August 12th at Canaccord Genuity, then Citi and Goldman Sachs in September. These are the make-or-break moments where management can provide crucial updates on AI product demand. If they show strong adoption of Bits AI, the bulls take over. If they hesitate, the bears are going to pounce.
So this leaves us with the ultimate question. Datadog's fundamental story, being a highly profitable, fast-growing leader at the center of the AI wave, remains completely intact. But are you willing to pay a massive premium with absolutely zero margin for error? Are you buying this dip, or are you staying safely on the sidelines? Think about that as you weigh this paradox of perfection. Thanks for joining me on this explainer, and I'll see you next time.